If you think a shipping lane is open when governments say it is, this story will change that. In April 2026, both Washington and Tehran announced that the Strait of Hormuz was completely open. Trump called it fully open and ready for full passage. Markets reacted instantly. But the people who actually move cargo saw something else. $10 billion vanished from the balance sheets of Vitol, Trafigura, and Mercuria in a matter of days. 49% of the global fertilizer supply froze in place, and 3,200 ships sat motionless inside a 34-mile-wide waterway. Not a single navy closed the strait. That is the paradox. A choke point can be open on paper and still function like it is shut. Why does that matter if you do not work in shipping? Because 80% of everything the world trades moves by sea, and the entire system runs on trust. When that trust breaks, no press conference or political handshake can put it back together. Fertilizer stalls, packaging costs jump, and grocery inflation shows up months later. In this story, we are not just looking at oil tankers. We are looking at the hidden system that decides whether food, fuel, and farm inputs actually move. At first, the reopening looked real. The S&P 500 surged 1.2% past 7,100, and crude oil cratered 12% to $83 per barrel inside the same trading session. Algorithm-driven commodity trading advisors, automated funds, piled an estimated $86 billion into equities over the following week. Almost none of them checked whether a single commercial vessel had actually sailed through. Then the weekend arrived, and the real picture emerged. BIMCO, Intertanko, and the International Chamber of Shipping fired off immediate counter-advisories. They pointed to unverified mine threats still drifting in the traffic separation scheme, the shipping lanes. Tehran demanded that every vessel follow a coordinated route under Iranian military oversight and pay transit fees. The United States kept its own interdiction protocols fully active on the other side of the strait. Intertanko spelled it out directly. Any ship owner who complied with Iran's routing and fee demands would face U.S. secondary sanctions and potential vessel seizures. Days after the open declaration, the Iranian Navy started broadcasting radio messages, insisting the strait was shut again to any vessel that lacked Revolutionary Guard coordination. So, the ceasefire existed only on paper. Vitol, Trafigura, and Mercuria had shorted futures contracts to hedge physical cargoes already on the water. When conflict first erupted, they were forced to buy replacement barrels at hyperinflated spot prices while bleeding through margin calls. Then, the false reopening headline dropped oil by 12% overnight, and the same firms were caught on the wrong side of the trade for the second time, with combined losses topping $10 billion. Researchers call this the false reopening premium. The idea is simple but brutal. Governments, navies, insurers, and ship owners define the word open in completely different ways. A government sees an open waterway as a legal posture under the UN Convention on the Law of the Sea, the basic rulebook for maritime passage. A naval commander calls a route secure when the military can guarantee survivability. But a marine insurer only cares whether the actuarial risk, the probability of loss, stays low enough that premiums do not consume the voyage's profit margin. A ship owner operating under a charter party contract, the shipping agreement, will not authorize a transit unless the master certifies zero unreasonable risk to crew and cargo. That is the real break in the story. One side was talking about legality. The other side was talking about tradability. And the most powerful gatekeeper in that equation sits in London, not aboard an aircraft carrier. The Lloyd's Market Association's Joint War Committee decides which waters receive high-risk designations. The moment a designation lands, standard insurance coverage vanishes. Premiums spike 300 to 500% per voyage. Port authorities turn away uninsured vessels. Banks freeze cargo financing, and charterers void active contracts. Two words define the result. Insured vessels sail, uninsured vessels do not. This is what the research calls the insurance weapon. A traditional naval blockade demands huge military resources and carries extreme escalation risk. The withdrawal of commercial insurance does something similar, but as a self-executing, privatized blockade. An adversary does not need warships or submarines. Cheap drones, loose naval mines, or anti-ship missiles scattered across enough open water can be enough to shift the Joint War Committee's risk calculus. Circular JWLA-033 proved the mechanic during the 2026 Hormuz crisis. The Joint War Committee expanded its listed areas to cover the entire Persian Gulf, the Gulf of Oman, and surrounding waters. Premiums surged by a factor of 60 overnight. A $100 million tanker that paid roughly $50,000 for Gulf War risk coverage during peacetime suddenly faced a surcharge of $5 to $10 million for a single transit. At the peak, specialized brokers were quoting 10% of the hull's total value. That arithmetic crushed the fertilizer trade first. A bulk carrier, loaded with 50,000 tons of low-margin urea, absorbed over $70 per ton in insurance costs alone. Global fertilizer markets run on razor-thin arbitrage windows, so this kind of freight penalty did not simply raise prices. It halted procurement entirely, and cargoes sat stranded at the port of origin. Most people notice Hormuz when oil is mentioned, but agriculture was sitting right beside oil in the blast zone. 20% of global petroleum liquids transit the Strait of Hormuz, yet up to 30% of global seaborne fertilizer trade passes through the same narrow gap. Nearly 49% of all urea exports depend on this single choke point. So do 87% of the Gulf region's ammonia, and a staggering 97% of its elemental sulfur. Each year, 60 million tons of fertilizers and raw materials leave the Middle East, and roughly 45 million of those tons rely entirely on Hormuz. Nitrogen took the hardest hit first. The Haber-Bosch process, which underpins modern agriculture, demands immense volumes of natural gas to synthesize ammonia. The Persian Gulf dominates that chain through cheap gas reserves, and because 20% of the world's seaborne liquefied natural gas also transits the strait, the closure did two things at once. It trapped finished fertilizer and constrained the feedstock needed to manufacture more elsewhere. Price spikes hit within weeks. Urea climbed 28 to 30%, roughly $70 per ton, pushing into the mid-$550 range. New Orleans urea spiked 43%, from $475 to $680 per metric ton. That happened squarely inside the critical spring planting window for Midwest corn and soy. In other words, the price shock landed at the worst possible moment. And this is where it gets worse, because biology does not negotiate. Agriculture runs on biologically rigid timelines. Nitrogen must reach the soil within narrow phenological windows, meaning narrow biological timing. A urea shipment arriving in late June is functionally worthless for a Midwest corn farmer whose application deadline passed 6 weeks earlier in early May. The market can reopen later. The crop calendar does not care. Across the U.S. Corn Belt, where 50% of nitrogen goes down during spring, farmers responded by ripping up corn and wheat acreage and replanting with soybeans, which fix their own nitrogen from the atmosphere. That acreage shift did not stay local. It cascaded into forecasted global grain supply. Structural deficits in staple crops were being created months before harvest. A shipping crisis had become an agriculture crisis. Sulfur fell next. Nearly half of the world's seaborne sulfur trade originates from the Persian Gulf, and without it, sulfuric acid production ground to a halt. That bottleneck choked global manufacturing of high-analysis phosphate fertilizers, diammonium phosphate and monoammonium phosphate in particular. African markets, which sourced 48% of their sulfur from the Middle East, were suddenly short on both agricultural fertilizer and copper mining chemicals. The choke point was now hitting farms and industry at the same time. Packaging collapsed alongside it. 1/3 of global seaborne methanol trade, 6.5 million tons of monoethylene glycol, and more than 40% of worldwide polyethylene exports all flow from the Persian Gulf. Indian plastic converters reported a 49 to 54% price spike in imported polyethylene and polypropylene within weeks. Fast-moving consumer goods firms refused to absorb those packaging cost hikes. So converters got crushed by margin compression, and the pressure moved straight into the food distribution network. None of this was unprecedented. Egypt sealed the Suez Canal after the 1967 Six-Day War, trapping 15 cargo ships in the Great Bitter Lake. The Yellow Fleet sat there for 8 years, while shippers diverted around the Cape of Good Hope, adding 8,000 to 10,000 kilometers to every voyage. When the canal reopened on June 5, 1975, the result was a textbook false reopening. Lingering war risk premiums kept cautious owners away, and the new very large crude carriers built during those 8 years were physically too large to fit the canal's dimensions. The 1980s tanker war proved a different point. Iran and Iraq fired Exocet and Silkworm missiles at neutral merchant vessels, killing more than 400 civilian seamen and damaging hundreds of ships. Washington reflagged Kuwaiti tankers and deployed Navy escorts under Operation Earnest Will. But on July 24, 1987, the reflagged tanker M.V. Bridgeton struck a covertly laid Iranian M08 mine near Farsi Island, while steaming inside a full military escort. One explosion made the lesson clear: armed protection does not equal commercial safety. By 2024, Houthi missile and drone attacks against Red Sea shipping triggered an industry-wide rerouting around the Cape of Good Hope. Suez Canal transits dropped 50% year-over-year, while Cape traffic surged 74%. Oxford University researchers put the exposure at $192 billion in trade annually, with direct economic losses reaching $10.7 billion per year. Egypt absorbed the worst of the financial damage. Suez Canal revenue collapsed from $10.25 billion in 2023 to $3.99 billion in 2024. That was a 61% drop. It erased $7 billion and equaled 5% of the country's entire GDP. Cairo was forced to expand its IMF bailout from $3 billion to $8 billion. It ended preferential tax treatments for state-owned military enterprises and enacted a currency devaluation that pushed the Egyptian pound to roughly 60 per US dollar. A maritime disruption had turned into a sovereign financial shock. The food procurement fallout came next. Egypt, one of the world's largest wheat importers, shifted procurement from the established General Authority for Supply Commodities to a military-linked entity called Future of Egypt. The new agency replaced the transparent tender system with opaque bilateral negotiations, demanded renegotiation of existing contracts, and delayed payments to suppliers. Wheat imports fell 27% in the first half of 2025. Government-secured purchases dropped 57%. Early 2026 brought another false reopening in the Red Sea. Maersk and Hapag-Lloyd announced plans to resume services through the waterway. Then, Houthi propaganda videos, captioned with the word "soon" and depicting coordinated attack scenarios, shattered whatever confidence the market had rebuilt. CMA-CGM immediately pulled its Asia-Europe services back around the Cape. Intelligence reports confirmed that the Houthis had used the previous ceasefire window to rearm. CUNY plus Nagel Data Analytics captured the scale of the 2026 Hormuz paralysis. 130 container vessels, roughly 2% of the global fleet, were locked inside the Persian Gulf. 3,200 vessels total, 4% of every commercial ship on Earth, sat trapped or idling in Omani waters. Analysts projected that even a complete and permanent ceasefire in April 2026 would require up to 24 months before global maritime chokepoints and equipment positioning fully normalized. A headline can declare reopening in one day. The backlog can take 2 years. Sanctioned states found their own workaround through the shadow fleet, old tankers that switch flags and go dark. Russia, Iran, and North Korea deployed aging vessels that hop between flags and disable identification systems during illicit ship-to-ship transfers. Gatic Ship Management alone grew from 2 vessels in 2021 to a $1.6 billion 58-ship fleet hauling Russian crude by 2023. But shadow fleets can move crude oil. They are structurally incapable of handling the specialized cold chain and chemical logistics required for fertilizers, feed additives, and agricultural chemicals. That left agriculture bearing a disproportionate share of the paralysis. Central banks watch these maritime crises land as severe external supply shocks. The Drewry World Container Index spiked 141% following the Red Sea disruptions. J.P. Morgan Research estimated 0.7 percentage points added to global core goods inflation, and 0.3 percentage points added to overall core inflation from the capacity reductions alone. Fitch Ratings modeled a 3.5 percentage point increase in U.S. import price inflation by the end of 2024. Grocery shelves absorb those shocks with a pronounced delay. 28 cents out of every food dollar goes directly to energy, transportation, and packaging. That is why 3 to 6 months usually pass before raw commodity spikes show up in retail prices. Researchers call this the rockets and feathers effect. Input costs rocket upward when tensions flare. But when a ceasefire is announced, retail prices drift downward like feathers, because manufacturers and retailers delay reductions to rebuild depleted margins. So the relief headline often arrives, long before the relief bill does. Euro area data puts hard numbers on the lag. A temporary 10% food commodity shock translates into a 3.8 percentage point increase in food inflation over the following 12 months. A one standard deviation increase in shipping costs elevates domestic headline inflation by 0.15 percentage points. The consumer burden of a maritime chokepoint crisis routinely outlasts the actual geopolitical conflict at sea by 12 to 18 months. That is why a false reopening matters to households far from any strait. Yemen sat at the center of the cruelest irony. Houthi militarization of the Red Sea threatened the very population the movement claims to govern, a country dependent on imports for 90% of its staple cereals. War risk premiums on humanitarian shipments climbed toward levels that would price out food aid entirely. Kenya faced a similar calculus. Its supply route from Novorossiysk, Russia, stretched from 4,200 nautical miles via the Suez Canal to 10,800 nautical miles around the Cape of Good Hope. That distance increase made basic food imports prohibitively expensive, and it points to the larger structural reality. The power to determine whether goods actually move has migrated from sovereign navies to insurance underwriters and algorithmic trading desks. No ceasefire matters until the Joint War Committee retracts its conflict designations and premiums collapse back to baseline. That is the real reopening test. And even that is not the end of the story. When carrier alliances eventually reinstate their standard routing networks, an estimated 1.8 million container units of excess capacity will slam into the market. Freight rates will crash, destination ports will get overwhelmed. Even after energy and freight markets begin to stabilize, consumers will still face a delayed macroeconomic shock. Bread, cereals, fats, oils, dairy, and fresh produce will carry immense pricing pressure as elevated diesel, fertilizer, and packaging costs work through the supply chain over the following 3 to 6 months. Retail food price stickiness guarantees that the pain at the checkout counter persists long after the last warship leaves the strait. Until the underwriters verify, the alliances reinstate, and the physical backlog clears, the strait is not open. It is merely claimed to be.